Hello everyone, my name is Stefan, a CPA here in Canada. This video isn't personalized financial advice, but it does explain how TFSAs and RRSPs actually work for the Canadian taxpayer. And the most common mistakes I see that people make when choosing between them. So here you can see on the website from the CRA, Canada Revenue Agency, you have more details about the TFSA and the RRSP. So the very first thing that I wanted to speak about is the mistake that people make when thinking about their RRSP. So your RRSP is not just something that you would use as a tool to, save on tax and get a deduction. The RRSP is meant as an incentive to make sure that you have enough saved up for your retirement. Okay. So the first thing that people do is they think, okay, I'm going to put money into my RRSP, I'm going to contribute into it just to save on some tax. So I don't have to pay a large tax bill, get a bigger refund. But that's not the way you should think about the RRSP. The RRSP is there for you to have enough saved for your retirement. Now, the thing about the RRSP is that the RRSP and the TFSA, they have different functions. And it'll serve you in a different way depending on your financial situation and on your personal life. Okay, so they're not the same thing at all. So I'll go and I'll describe what the RRSP actually is and what it's good for right now, and then how it works. So the RRSP is essentially a deduction that you can take off your income. All right, so what that means is, let's say you have employment income, business income, rental income, right? That is all going to eventually hit your net income, which will then become taxable income. This will again be another video. But you are allowed to take a deduction to lower your net income, okay? Your net income for tax purposes, what they call it. So let's say you have $100, let's say you have $100,000 that you make in total employment income, okay? Then you contribute 10,000 into your RRSP. That'll actually be a deduction of 10,000 to make your net income for tax purposes be 90,000. So that's 100,000 minus 10,000. So if you didn't have this RRSP deduction, you would be taxed, your 100,000 would be taxed fully, right? Whatever your rate will be, because it's there's a certain rate for each dollar that's made, but the whole 100,000 would go into your taxable income. But when you have that $10,000 contribution, it brings your net income down to 90,000, and only 90,000 of that will be taxable income. Okay, so that's kind of the purpose of the RRSP, or in the sense of how it would work on your tax from a tax basis. The thing is, you can't contribute as much as you want in your RRSP. You have a deduction limit, okay? Now, the deduction limit is based off of two things. So it is the lesser of 18% of your earned income in the previous year. Very important that it's from the previous year. And earned income. So earned income is your employment income. Essentially, for most of you, it'll just be your employment income. But if you are self-employed, it would also be your self-employed net income. It would also include your rental net income. But anything other than that, any investment income would not be included here. So for, the sake of simplicity, we'll just think of it as your employment income of your previous year. And your annual RRSP limit, which for 2024 was 31,560. So it's going to be the lesser of the two. So if you had 100,000 last year of earned income, that would mean 18,000 would be the amount here, and 31,000 for 2024. So the lesser of those two would be the 18,000. So you'd only be able to deduct 18,000 of an RRSP deduction on your tax return. Don't really worry about these pension adjustments. They're not very common at all, nor is the pension adjustment reversal. So we're not really going to look at it. All we're going to talk about is these two main things, which is the 31,560, which is a number that the government inputs, they decide that, and the 18% of your earned income in the previous year. So in our previous example, if we had 100,000 of employment income, then and we wanted to take the full deduction, then we would deduct 18,000. Okay, and then our net income for tax purposes would be 100,000 minus 18,000, which would be 82,000. Okay, so you're able to contribute up until you turn 71. Then it becomes an RRIF, which is something different, but don't really worry about that. You're again meant to use it as a means for retirement, so it wouldn't really make sense for you to be able to keep using it after a certain age. In this case, it would be 71. When you are making a deduction or you're contributing, you get up until March 1st, 2024 you get March 1st, anywhere from after March 1st, 2024 to March 3rd, 2025. So in general, that the rule is 3 months after the year end, you can contribute for the previous year. Okay, so they give you leniency there. So you can input money, even though it's the next year, to deduct it for the previous year. Because as you know, your tax filing that you'll be doing for your T1 will be in April 30th. That's the due date, April 30th. Okay, so then we'll look at the TFSA really quickly. So the TFSA is a tax-free savings account. That's what it stands for. So the basis of the TFSA is that you can invest into something, into a TFSA, into an account, where if you have any income earned in the account, it won't be taxed. So what does that mean? So let's say you, again, have $10,000 into your TFSA, and then there's a really good year in the stock market and you get a 10% return, then that $1,000 earned will not be taxed by the Canadian government. Okay, that will be tax-free. So that's why it's called a tax-free savings account. Now, again, here you don't get a tax deduction like you did with the RRSP, but any future income earned in this account will not be taxed. So you can see kind of the difference there, that both of them have different purposes and can be used at different times depending on your situation. Here, they can be self-directed, okay, but you lose it if you are trading like a professional trader, so that's something you have to think about. One of the things that for your TFSA is that limit, the contribution limit, or that limit that you have to contribute to your TFSA, that starts when you're 18 in January, and they give you a certain amount. So for 2025, it's 7,000. For the previous, I think 2024, it was 6,500. But it's given to everyone. Okay, it's given to everyone, and it builds up over time each year. If you don't use your TFSA contribution limit in the year, it'll just add up for the next year too. So you'll be able to use it in the future. You won't ever lose it. And it's the same thing that I should mention with your RRSP deduction limit as well. If you don't deduct it in the same year, you won't lose it. You can use it again in the future as well. Okay, so the question now is, how do I know whether to contribute to my RRSP or my TFSA? So in very simple terms, it depends on your net income. Are you a high income earner or a low income earner? Okay, and what that means is essentially you want to look at what your marginal tax rate will be for each dollar earned. Okay, so at some point it's very high. Okay, your provincial and your federal rate will be taxed at about 50%, something like that, 49, 51, somewhere between 49 to 51. If you're earning, let's say, 300,000, each dollar after 300,000 will be taxed at that rate. That would be considered a high income earner. And then you have lower income earners who, let's say, make less than, call it 15,000 in the year, then they don't get taxed anything, okay, because you get a credit for that, which it's called the basic personal credit, but we'll get into that in a different video. So essentially, if you are a high income earner, it is better for you to invest or contribute into your RRSP, okay? Because that net income deduction means a lot more, okay? And what that means is you might be getting taxed for each dollar at 50%. And then when you deduct it, you essentially will save on that 50% tax that you would you'd have to pay. And then when you withdraw it in the future, when you're retired, you will only pay, let's say, 20% or 30% on that dollar. So it would make sense in the sense that if you're a higher income earner now, you should be contributing as much as possible into your RSP, because at some point when you retire and you take that money out of your RSP, you will be a lower income earner and you will be taxed less. Okay. So what's important to mention is that your RSP, it's not tax free like your tax free savings account. When you withdraw that money out and you're retired, you will have to pay tax on that, depending on how much is your net income, right? How much will become taxable income. So if you're a high income earner now, you will take the deduction because you'll save, let's say, 50%. And then in the future, let's say you take that money out when you're retired, you'll only pay 30%. So you have a net savings of 20% when you look at it like that. Okay, so these are for high income earners. It is essentially a good way to save on tax in the future. Save on tax now, but it'll also save with your net tax bill. Your TFSA, on the other hand, is more for lower income earners, perhaps students, maybe you're working part-time. That's because you don't have a tax deduction like you had in your RSP, but that tax savings that you get will be with any income that is earned in your TFSA. So it would make more sense for you now to earn, to input that money when you're not being taxed very much on the income that you earn, and then have that income increase over time. That savings, the investment increase over time. And then from there, you'll be able to withdraw that money from your TFSA and not have to pay any tax on it. Okay, you won't have to pay any tax on that. So the TFSA and your RRSP, they're both very good instruments for your investment. They both depend on different situations in your life. And you don't want to get it confused in terms of, is the RRSP, I get to save on tax now, so I should invest in it regardless of how much I am of an earner, if I'm high or low. No, you want to think of your RRSP as it's incentivized for your retirement. Why? Okay, if I'm a high earner now, then I should invest in it. If I'm a low earner, or I'm working part-time, or I'm a student, then I should put my money into the TFSA. Okay. And then again, your RRSP, that'll be essentially, you'll have to make earned income for you to get the deduction or the contribution limit. Here, off your TFSA, the contribution limit will be given to you each year. It'll go up by a certain amount. In 2025, it's $7,000. So that's the difference. We can do a calculation in a future video to actually show you a scenario where it will be better for you to have, say, a TFSA versus an RRSP. Okay. So if you have any further questions, put a comment down and I can answer them. Again, this is not financial advice, and it doesn't take into account the complexities of perhaps having, anything to do with reorganizations or any cross-border, U.S., Canada, or any cross-border tax implications there. This is just simply looking at what is the TFSA. Even here, if you wanted to look yourself, you could find a lot of information from the CRA website, as well as looking at the RRSP, the deadline, who can contribute, etc. So there's definitely a lot of tools out there. Hopefully you now have a better understanding of the differences between an RRSP and a TFSA and when to use one over the other. If you want clear, practical Canadian tax guidance explained by a CPA, subscribe to the channel. I'll continue to add new helpful tools and resources as the channel grows.